welcome to Credit Compass, your guide to navigating European credit markets. This week I have two of my colleagues from KBRA Direct Lending Deals, Rachel McGovern from our Dublin office and Eric Rosenthal from our New York office. Thank you both for joining me. For those of you that do not know KBRA DLD, they are a private credit news and research service offered by KBRA. They provide insight into direct lending strategies, pricing shifts, and covering default risk across both the US and Europe. So I thought it would be good to put aside all the public noise and shed a little light into the private credit world. The private credit world has grown rapidly here in Europe, growing to reach over 500 billion euros for the direct lending market in Europe. And with the dislocation and fragmentation of the banking sector, the market is set to continue to grow. However, the media and regulators have raised concern about the sector, given the rapid pace of growth and types of collateral being underwritten. As we have highlighted a couple of weeks ago, the ECB investigation into the sector highlighted a greater concern about secondary market impacts on the rest of the balance sheet rather than any direct exposure. However, they continue to investigate. Here at KBRA, we have our fingers on the pulse, and as my colleagues will explain, it is worth shedding a light on what is really happening here in European private credit. All right, so let's get started. Eric, you guys have done a great deal of work into building an index of defaults in the private credit world, both in the US and Europe. Do you mind just quickly explaining to our audience what the index is and how it has been constructed, and most specifically, what it covers here in Europe?
Thanks, Gordon, for having us on the podcast. So the KBRA DLD Europe Index includes 400 European companies held by public US BDCs. These borrowers are direct lending issuers totaling $31 billion in BDC holdings. While this represents only a fraction compared to the 3,000 US companies and $300 billion tracked by the KBRA DLD US Direct Lending Index, growth in the European index, it is notable. The number of European direct lending companies has doubled since the index launched in February of 2024. Currently, about 70% of the companies on a count basis are based in Europe's largest direct lending jurisdictions, the UK, France, and Germany, and more than 90% are sponsored. In addition, the software sector accounts for nearly one-third of the volume, which is similar to what we see in the US. The index is designed to provide insights into early-stage stress and potential defaults, where visibility is otherwise essentially non-existent. Our default radar is a color-coded two-tier watch list that highlights credits showing weakness and is one of the features clients probably value the most. There are 21 issuers on default radar, including 9 of the more concerning red list. We publish this table quarterly, along with default, implied recoveries, as well as market stats.
Thanks, Eric. So, Rachel, what have you been seeing with regards to the deals that are showing signs of distress and either defaulting or progressing through some kind of a workout? Are there any notable trends that you are seeing in the private credit workout world?
Well, I think the last time we were here, we talked about the two main types of borrowers restructuring that we see. And that's deals that are hitting a maturity wall after failing to refinance, and the sponsor typically walks away. And the pandemic era 2021, 2022 deals, where previously high growth business models just didn't work once we were all able to leave our houses again. If you think kind of niche hobbies or garden furniture retailers, we've seen a lot of those. What's now starting to come through in our data, and it's coming through both from within the index and within defaults we've tracked in the broader direct lending market, are these double defaults. These are borrowers who agree an initial restructuring with lenders, but quickly find that the first deal wasn't enough to steady the ship. And then there's a second default. Seller X is one example. It restructured, and that reworked debt was then held under a new name by the lender, Infinite Commerce. That debt went from being marked at par to a fair value mark of 0 in a single quarter, which is not a great look, particularly if you're not aware that this was a previously restructured borrower. Among that double default cohort, we've also seen several examples where the second restructuring has occurred less than a year following the first, which suggests that the initial moves to address the borrower's problems are neither early nor deep enough.
Thanks. So, turning back to you, Eric. So, how has the market progressed in terms of defaults in European loans? Where are we relative to the recent past, and where do you think we are heading in the near future?
Right. So the trailing 12-month default rate that actually increased to 1.5% by volume, up from 1% at the year end 2025. We saw five defaults totaling 172 million this year, which kind of drove the rate a little bit higher. Now, the good news is that nearly all the 2026 default volume that was already reflected in our forecast. That remains at 1% for the year, which is based on roughly 300 million in default volume. Now, while the default rate rose, non-accrual volume actually declined. There was just 186 million in volume compared with 245 million at the end of 2025. ES Group was the only issuer placed on non-accrual in the first quarter of 2026. Default radar, as a percentage of the index volume, also dipped slightly. It's accounting for 3.4% of the index. Average fair value marks across the 400 index borrowers also ticked up slightly to 97.4 from 97.2 in the fourth quarter of 25. Taken together, these indicators point to a relatively favorable default environment in Europe, at least in the near term. This trend is even more apparent compared with the US, where the default rate is expected to end 2026 at a higher 2.5% rate.
Thank you, Eric. That sounds very interesting. Rachel, so when these deals finally do trip over and go into default, what have you been seeing with regards to pricing, losses, and recoveries in European credit?
So while the news is good on the outlook for defaults, on recoveries, it isn't quite as positive. As I'm sure you'll understand, there's very little hard data on actual recoveries in the European direct lending market. So we track implied recoveries for the group of defaulting borrowers within our index by taking the fair value mark in the quarter prior to the default. And right now, the average implied recovery rate stands at 32.6% in Europe. It's a small sample, admittedly, particularly when compared to our US data, but it's the best insight we can currently get into the market. And it shows that the recovery outlook in Europe is materially worse than the US, where the average is 52.5%. We can explain some of that difference. In the European data set, more of the defaults are marked at zero than in the US, which usually means the quarter prior to the default, the asset had a lower fair value overall. Why they are marked lower, part of that is down to the different restructuring regimes in different European countries, many of which are not as creditor friendly as the US or the UK. There's a reason for the old joke that there's no such thing as senior secured debt in France. But market players have also said that Germany equally can be a creditor's nightmare if the sponsor opts to become uncooperative. Perhaps it reflects some bias among US headquartered BDCs with US led investment committees. But from my point of view, it's a data signal that backs my experience of tracking these direct lending defaults in Europe. So, on the rare occasions where I've had full visibility on outcomes, either through public documents or conversations with my sources, the recoveries are either pretty strong and in the 90s or worryingly low and in the 20s. This is one aspect of the market that investors need to keep an eye on and grill their managers about. How will you get my money back if things actually go wrong?
Thank you very much, both. That's very interesting. And just, I guess, in summary, what we are seeing here in Europe is a relatively benign environment in terms of private credit and the risk of default. However, once that does happen, there are plenty of red flags to be concerned about within Europe. That's it. That's all for this week's edition of Credit Compass. Thank you again to Rachel and Eric. You can find their reports as well as our reports on KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.